Greetings, welcome you all. This is Sundar from Canary Capital Solutions. Very happy to connect with you again through this video. Today we are going to speak something very important. Don't risk all your money. Meaning some part of your capital should be always safe. So how do you keep your capital safe? One of the best ways to keep your money safe all these years was through an FD. Is there any better alternative to keep your money safe? Yes, of course, that's what we are going to see in this video. So under mutual funds, there are different categories. So whenever we hear the name mutual fund, what comes into our mind is equity mutual funds. There are other categories also. You can also invest in gold through mutual funds. You can also invest in debt funds where your money can be safe and it also can grow over a period of time. So what we are going to see is the debt mutual fund. So how does a debt mutual fund work? Like an FD. So anybody who needs money, who is the borrower, okay, always pays the interest for the money he is receiving from the lender. So like in an FD, you go and deposit money in a bank, the bank becomes the borrower. For the money what you have deposited, the bank pays you an interest. Similarly, anybody who raises money pays you a fixed interest, and that becomes the part of your returns from an investment point of view. So who borrows? Almost everybody borrows money because everybody needs capital, right from the banks to the public sector units to the government of India to the private sector companies. So almost everybody borrows money. So under debt, there are various categories available. So right from short-term funds to medium-term funds to all-season bond funds, banking PSU fund, liquid fund, etc. So I'm not going to cover all the categories because each is for different set of investors. So what I'm going to speak about is two category of funds which will be useful for all type of investors. The first what I'm going to speak about is liquid fund. So as the name suggests, these are highly liquid funds where the money can be taken out at any point of time without risking your capital, and generally your money grows more than a savings account. So one, the money is safe plus highly liquid, plus it also makes a little more money than a savings account. So that's the best advantage. So how as an investor can you benefit? So whenever you are unsure of how long the money is not needed, it can be kept in a liquid fund. So it could be 1 month, 3 months, 10 days, whatever could be the time frame. Liquid fund can actually be a good place to keep your money safe. Also, you can create a contingency corpus through a liquid fund so that whenever you need money, you can take it out. Or if you are saving for your school, for your child, for your school fees 1 year from now, you can actually keep the money, whatever you've accumulated, in a liquid fund so that as and when the school fees is due, you can take out the money and pay it. And you can also make good amount of returns out of the investments what you've made. You can either do a SIP, say you want to accumulate 1 lakh rupees end of the year, you can keep doing a 10,000 rupee SIP or 8,000 rupee SIP. So end of the year, you have the money safe and also you make some returns out of it. The next category what we are going to see is banking and PSU fund. As the name suggests, the money is lent only to banks and public sector units, which means the safety of these funds are as the highest. So I've just shown you a portfolio of a banking and PSU fund, which shows you how safe the money is. If you look at, there are about 40 to 50 places in which your money is invested, right from the State Bank of India to Axis Bank to the Government of India, and there are many other good names also which are available. So at a safety, it is one of the highest. And how have these funds performed in the last so many years? If you look at over the last 5, 7, 10 years, the funds have always delivered returns of more than 8.5%. Of course, the rates also were higher during those period. If somebody invests today, ideally you can look at a return of close to about 6% or so. But the money is at the highest safety level and the money is always liquid. So that's a greater advantage. Apart from this, the most important advantage of keeping your money in debt fund is the taxation. You actually score a lot better compared to an FD. So the table here shows very clearly, if you invest 1 lakh rupees in an FD and 1 lakh rupees in a debt fund. After 3 years, if your interest rate is 7.25%, then your maturity will be 1.23 lakhs end of the third year on both the products. In a FD, if you are under the highest tax bracket, on the 23,000 rupees, you end up paying about 7,000 rupees as tax. That means what you get in hand is about 1.16 lakh, which is 16,000 rupees of interest. The same in a debt fund, because of the indexation benefit, because you've stayed more than 3 years, your taxation is only 1,500 rupees. That means you will end up having about 1,21,000 rupees, almost a 5,000 rupees of difference over 1 lakh rupees, which means your net yield post tax on an FD will be somewhere close to 5%, whereas in a debt fund it is somewhere close to about 6.5%. So this is a big saving for people. You make almost 1.5% more with the highest safety also. So a debt fund can ideally be suited for almost every investor, irrespective of whether he's a young investor or an aggressive investor, because everyone needs to keep some part of your capital safe. So anybody can invest in a debt fund. In fact, debt fund should be definitely part of everyone's portfolio. Just to summarize of whatever we have spoken, debt fund outscores in terms of liquidity, flexibility and taxation, and also the ease of investing. It could be invested online either through a SIP or lump sum, and the money also can be withdrawn anytime through online. So with all these features, debt funds actually works as a better alternative than an FD with greater flexibility. Hope you found this video interesting and informative. Thanks for watching.